Prices fluctuate gradually throughout the day, and our minds often seek immediate explanations for every shift. This quest for answers generates noise, as explanations typically arrive late and rarely enhance future decision-making. A more effective strategy involves observing current events before acting when the evidence is sufficiently clear. Tape reading is the practice of analysing the flow of trades and quotes to gauge demand, supply, and market direction. The cost of confusion can be significant, leading to delayed entries and exits that exacerbate errors. Overconfidence also carries a high price because it can lead to oversized positions, making small mistakes much more impactful. A trader might feel secure by monitoring every tick, but this can devolve into a habit of constant reaction. Conversely, another trader may choose to take fewer trades, waiting for scenarios where conditions align and risk is clearly defined. We will explore concepts such as pattern recognition, patience during significant moves, skepticism towards tips, and practical risk limits. This video draws inspiration from Reminiscences of a Stock Operator by Edwin Lefèvre, so be sure to subscribe for more insights. Tape reading begins with practice, as similar setups tend to yield similar results across different trading days. The process relies on comparison, matching current behaviour against historical patterns to develop a probabilistic outlook. When we view prices as shifting numbers rather than narratives, our focus remains on movement and momentum. This focus is crucial because explanations can be delayed, while the window for making decisions may quickly close. A useful exercise is to document your observations and later compare them with actual tape transcripts to assess your accuracy. This feedback loop transforms memory into method, and method into discipline that withstands emotional fluctuations. An important point is that markets tend to recycle behaviours, allowing precedents to serve as a valuable reference rather than mere trivia. When current circumstances resemble a prior pattern, that pattern can effectively guide your sizing, timing, and patience. A practical next step involves creating a personal dope book that outlines setups, triggers, and what could invalidate them. Keep your definitions clear and regard every signal as a probability rather than a guarantee of being correct. While constant activity may seem productive, it often replaces thoughtful analysis with mere motion, turning trading into a form of entertainment. The tendency to chase minor moves results in commissions, delays, and errors that can dilute predicted outcomes. Execution is critical because a quoted price may lag behind reality, and a large order can influence the price itself. When this occurs, even an accurate forecast can lead to losses, as entries and exits may stray far from the intended levels. A key distinction exists between a bucket shot bet, which prints tickets instantly, and an exchange order that fills afterward. The lesson lies in adapting your method to the specific market environment, as the same strategy may falter if the dynamics shift. Another common pitfall is feeling obligated to trade every day, even when no solid reasoning or sufficient knowledge supports it. This pressure breeds random positions reliant on luck, and relying on luck inevitably leads to downfall. A powerful strategy is to trade only when past patterns support your decision, and to stand back when they do not. This method alleviates stress by minimizing decision-making, allowing more time to confirm signals and establish exit points. Significant changes arise from the broader market trend, rather than from perfectly timing every minor shift. The key lies in aligning yourself with the prevailing trend and holding onto your position through typical fluctuations. This approach transforms outcomes because the most substantial profits originate from sustained movement, not from constant small trades. It also minimizes mistakes, as fewer trades mean less risk of errors in both execution and judgment. An experienced trader often emphasizes a crucial truth in a bull market, using it as a shield against hasty selling. Such patience demonstrates the importance of resisting the urge to protect unrealized gains until genuine changes occur. A practical tip is to forgo focusing on the beginning and end of each movement, as those extremes can be costly. Paying attention to the line of least resistance is helpful, as steady gains with minor reactions contrast sharply with a market nearing a peak. A sensible next step is to concentrate on the overall conditions, take a position, and commit to it. If these insights empower your trading with greater patience and clarity, consider subscribing for more in-depth market analysis. While tips may seem like shortcuts, they can shift your judgment away from independent thinking and lead to dependency on someone else's timing. This system is fragile because the person providing tips might disappear right when you need to make urgent selling decisions. Insider information can be misleading, as those with the most knowledge rarely disclose the entire truth to outsiders. Publicity can mislead at critical moments, aiming to draw in buyers while insiders discreetly strategize exits. One common red flag is mixed messages, where different groups are directed to both buy and sell the same stock. The key takeaway is that information can be crafted to stimulate trading activity, not necessarily to protect the recipient. A more beneficial perspective is to trust your own analysis, accepting responsibility for your trades, including entries, exits, and losses. This builds reliability as consistent rules apply to buying and selling, rather than shifting with the latest rumours. A light next action involves treating every piece of advice as background noise and returning focus to price movements and overall conditions. When the desire for insider information arises, take a moment to pause and restate your decision in your own terms. A bucket shop is a gambling venue that monitors quotes, but may not engage in actual trade executions on the exchange. This setup creates traps, as the house can modify margins, incorporate extra fees, or decline specific orders. This matters because the odds can be stacked against customers, even when they correctly predict market direction. Another risk is manipulation, where a shop can induce price fluctuations that wipe out numerous positions simultaneously. A trader who senses discomfort can promptly choose to close their position, even without a clear rationale. This decision reflects effective risk management, prioritizing the safety of your capital over the pride of making an accurate prediction. A vital strategy is implementing a stop-loss rule, which minimizes potential losses when the market behaves unpredictably. In some trading environments, an automatic closure at the margin limit functions like a mandatory stop-loss, preventing excessive losses. A practical approach is to determine the maximum loss you can accept before making a trade, and then position your size so that loss is manageable. Distinguish between the impulse to act and the necessity to be active. Keep your risk limits as absolute. Ultimately, true success arises from a consistent process, rather than relying on a single great decision. The fundamental shift involves aligning yourself with the market's direction, prioritizing its movement over personal pride. Effective strategies include analyzing patterns, waiting for high probability scenarios, and resisting the urge for constant trading activity. They also demand a healthy skepticism toward market tips, a keen awareness of venue incentives, and strict limits on your losses. Over time, adopting these habits reduces unnecessary trades, allowing you to focus on more significant opportunities. These practices also help stabilize emotions, as following rules mitigates panic and discourages impulsive revenge trading. Start today by drafting a set of rules concerning your entry, exit, position sizing, and the specific conditions that would cancel a trade. Next, analyze your recent decisions, identifying which rules you adhered to and which ones you overlooked. With repetitive practice, your decision-making will become more composed and the process will feel more manageable under stress. If you're interested in gaining deeper insights into market psychology and execution techniques, subscribe to foster this discipline further.